Hello again, students. We continue with chapter 15, Microeconomics Pindike. This is under topic investment, time and capital market. Yeah? So 15.3, value of a bond. A bond is a contract that the borrower, in this case a firm, agrees to pay the lender, in this case we call the lender the bondholder, a stream of money over a fixed period of time. Okay, so in other words, this is an IOU contract, payable at a fixed period of time, a fixed interval of time, let's say monthly or annually, but the amount of payment is the same. Let's say $100 per month or per year. Okay, so as a borrower, as a lender, we will wonder what is the value of that 100 that you're going to receive over, let's say, 20 years. What is the value of all those money in today's terms? Okay, because you're paying for that or you're buying that bond today, you're putting out your investment today. Okay, so let's see, in this case, the PDV of the formula is going to be very straightforward here. The PDV is going to be, let's say, 100, 1 plus R to the power of 1, because you only start receiving income or payment interest after first year, and then so go second year and so on until the last year. Okay, let's say the last year is 10, n equals to 10. So it all depends on the R rate that you're going to get. Okay, the principal is 1,000, and what is the interest rate? If the interest rate is 5%, then the PDV of a 10-year is 1386. If the interest rate is 15%, then it's 749. Okay. Now, perpetuity is a special kind of bond in that the N is not fixed, the N is infinity. So the present value of the payment stream is given by the infinite summation. It's straight away just like this: P dV equals to 100 over R. So you don't need to do the 1 plus R. Okay, so if your R is equals to 0.05 or 5%, then PDV is 100, so it will be 2,000. If R is 20%, then PDV, and the 100 that you receive monthly, divide by 0.2 will be 500. So again, what you see here is that the higher the interest rate or the R, the smaller the PDV. Okay, you see, you use 20%, your PDV is 500. But if R is 5%, your PDV is 2,000. So you still have the same inverse relationship, except that for perpetuity, the formula is a lot more simple, in the sense. Okay, now let's go back to bond, and we come to this concept of effective yield. So you're buying a bond in a secondary market. It's already been traded, it's already been issued, so you purchase a bond in a market. Okay, if it is a perpetuity, then if you pay for the market value, let's say price of the bond that you're paying is 1,000, and you know the interest rate is even if you don't let's say you don't know the interest rate, you have the price that you pay in the market is 1,000 for this bond, and the bond promise you to return to pay 100, the interest per month. Okay, so your present, so the formula just now, the PDB will be 100 divided by R, correct? In this case, we're going to change this. We want to find what is the R that such a sale is going to give you. What is the effective yield or the discount rate that will appear from this particular transaction? So you paid today 1,000. This is your PDB. Okay, so R, just switch, cross multiply, and this one will be 100. So that means the R that you are getting from that transaction is 10%. This is what we call effective yield. Okay, this is the effective yield that you are receiving when you make this purchase. When you buy a bond at 1,000, knowing that you receive 100, that means you know that you are getting a rate of return, or you are getting this, what we call effective yield on the bond of 10%. Okay, and but if it is not a perpetuity, if it is a bond, okay, this one just now is a perpetuity. Okay, so let's look at case of a bond now. If it is a bond, similar, you have price 1,000, and because it's a bond, you have a fixed N, 10, and the coupon or the price, the coupon is equals to 100. So you're going to have to lay out the payment, the income stream like this. So this is the return from year 1, year 2, year 3, year 4, year 5, year 6 until year 10. Okay, and to know what is the effective yield from this purchase, you purchase at 1,000 off the market. So to know that, you can work backwards. So if you pay 1,000, then you just need to solve for R. Correct? Yeah? Okay. But to make things easier, we use an effective yield curve, or the yield curve, we call it. So if you are the bond value, the effective yield is found by drawing a horizontal line at the level of the bond's price. So if you come into the market and you purchase it at 1,000, or 1 times, if the 1,000 is actually 1, because it's the same as the issuance price, so the yield that you receive is 10%. So this is your 10% yield. Okay, so you just draw a line at the yield curve. But if you come in to the market and paid 1,400, or 1.4 times the issuance price, the nominal price, then your yield is 0.05 or 5%. You see what I'm saying? Yeah. If you come in and buy 600, that same bond was sold at 600, then your yield is what? 18%, 17%. Yeah. So what does it mean? Again, you have an inverse relationship. All right. And the higher the risk, so you have inverse relationship. And secondly, you will see that the higher the lower the price that you purchase the bond, the higher the interest rate, or the higher the yield. But the higher the yield, why is the price so cheap then? So you start asking, why is the price so cheap? If something is really sought after, demanded by the market, then the price would go up, right? But why is the price so cheap? This could be due to the risk associated with the bond. That means the loan, or the bond is high risk, such that it goes very cheap in the market. Alright, so if you purchase it, yes, you will get a high yield, but you also have to bear with high risk. That's why we say in markets, high risk, high returns. Yeah? So only risk averse buyers would buy the bonds, knowing very well that it's high risk. High risk of default, high risk of many things. Okay. Okay. So for 15.4, we go to capital net present value criterion. Net present value criterion is very simple. Invest if the present value of the expected future cash flow from investment is larger than the cost of investment. Okay, so if the present value of your investment is larger than the cost of the investment, and if you use a net present value, the net present value will be the present value of returns, minus the cost of return. So that's why we have the word net in front of that. Okay, what is the difference between what you receive from the investment and the cost of the investment? So that's the net present value. So you invest when the net present value is greater than 0. Okay, so the adjustment to the formula is like this. When you use NPV instead of PDV in the previous sections. So NPV, you must put in the cost at the beginning, and then let's say we are talking about profit here, profit in year 1 divide by 1 plus R to the power of 1 and so on. So profit in year 2 divide by 1 plus R to the power of 2 and so on, so on, so on until year 10. If you're 10 years. Okay, so again, we find out which discount rate that we are supposed to use. Okay, but you invest only when NPV is greater than 0. So, right? So where's the next? The next question will be I'm going to work out this example for you. This is too small. Okay, let's work out this example by hand. So you have cost per unit, 42. Sold. So price per unit is 52.5. Okay. So profit, and then since you have 8,000 units quantity, so profit will be 8,000 times the profit per unit just now is between these two is $10. So that's where you get 80,000. Okay, the quantity here, revenue, cost. Okay, and then scrap value. Scrap value is 1 million. Okay, profit per year, this is month, so profit per year is 80,000 times 12, 960K per year. Do you follow it? Okay, so with all this information, we set out the this is what you got. The initial investment is 10 million. Okay, so now we can set out the NPV. The NPV is that the business make an investment of 10 million in the beginning, and then it receives 0.96 million, this one, in the first year, up to how many years? 20 years. Okay, N is 20. And at the end of the 20th year, you can sell the factory for 1 million. So what is that 1 million in 20 years? Right? So this will be the full expression of the net present value. Your cost, and also whatever scrap value that you get at the end, the income that you expect to receive in that period. Okay. So if you use a yield curve just to look at where it is profitable for you, where the NPV, the rule is just now to only produce if your NPV is greater than 0, right? So let's say the NPV equal to 0 here means that this is the R that you're going to use. So if the R here is 7.5%, okay, your effective yield must be below than 7.5%. The NPV is positive. It is greater than 0. NPV greater than 0. But after or higher than 7.5% discount rate, then NPV is less than 0. That means you shouldn't be investing. Okay, so it's the 7.5% that is what we call the internal rate of return of the investment. That the investment is only possible with a minimum expected rate of return, which is 7.4%. Otherwise, you will not make that investment. Okay. Okay. Right. One quick reminder, since we did not take into account inflation in all our discussion here, whereas inflation is a permanent feature in most economies, so or even deflation, you can also use the same argument here. Therefore, the discount rate should always be referring to the real version of the discount rate, the real in terms of nominal. So real interest rate, as you already know, is the nominal rate minus expected rate of inflation. Okay, so the real interest rate is nominal interest rate minus inflation. So there you get real interest rate. So the 7.5% that we were talking about just now is the real interest rate. This is the NPV equals to 0, which means that if your inflation is, let's say, 2.5, then your nominal interest rate that you look at in the market might be a 10, in order to get that 7.5 real interest rate, if inflation is 2.5. So these numbers will change, but what you want is the 7.5 to be real interest rate, so that you will not be misled by the discount rate that you're using. So what if the company make losses in some years? So let's see, from all this information, same quantity year, 1 million scrap value, lose 1 million first year, and then 0.5 million and then second year. So it's still the same thing. 5 million is spent in the first year, another 5 million is spent in the second year. So you've got to craft your NPV expression carefully. So first year 5 million, no discount. Second year 5 million spent. I'm talking about this one, spent in the next year. So that has to be discounted. And then it's expected to lose money in its first year, so that's another negative. Okay, in its first year of operation. and then 0.5 million in the second year of operation. This is the first year, this one. So you make 2 years of setting up, and then this going onwards will be the operations. After the third year, you start making 0.96 positive. And this goes on until the 20th year. So now this becomes 1 plus R at the year 20, and then you have that scrap value at the year 20. So this operation, and then this one is a scrap value. Okay, so be careful how you set up your income. Okay, we stop here.